how to manage your RSUs. So that's what we're going to talk about today. And before we get started, I just want to introduce myself. My name is Joe Morgan. My firm is Best Financial Life, and I work with families, mostly women, but families who want to live their best financial life and really accomplish everything they want in life. I'm a CFA and a CFP. I spent 25 years on the institutional side and now 5 years working with families, and just really love helping out the folks in the neighborhood. I've got a picture here. I recently made some barrel-aged whiskey sours, or I should say I put them in the barrel a couple weeks ago. So they'll be ready in a couple weeks. If you haven't done the barrel aging for cocktails, and if you're a whiskey fan, I highly recommend it. It's a very cool thing. I'd be glad to hook you up with where I got the barrel and the recipes and all. If you're interested, let me know. Before we get into the real content, I have to say that this is not financial advice. Financial advice should be specific to you and your situation. We all have a different situation. We all have different goals, different desires, and we all have different ways of thinking about our money and different histories with money, and all of that affects what would be the right course of action for you. What I'm talking about here today are some possible money moves, what I like to call money moves, particularly related to RSUs. And I did do a webinar about a month ago on what is financial planning. If you want to see the replay of that, hit me up. I'll send that to you. So let's get into it. So what is financial planning? So this is my vision of what financial planning really is. I believe there's 4 areas. There's protect what you have, know where it goes, so that's spending, make it grow, that's investing, so that's kind of where we're going to be focused today, and then retain independence and dignity, and that's where we were focused last time when I did the webinar a month ago. Now we want to approach all 4 of these areas with intention and purposeful effort. And if we do that, we can build our best financial life. And I'm not talking about the best financial life, I'm talking about the best financial life that you have available to you given your situation and your hopes and dreams and desires. So that's really what this is all about. So let's get into it. What is an RSU? RSU stands for Restricted Stock Unit. This represents a share of stock. It's very similar to owning a share of stock in your employer. These are awarded at certain dates, usually at review time once a year, and then they vest over time. Sometimes they'll vest once a year, sometimes they'll vest once a quarter, sometimes even once a month. So it depends on the plan that you're in. All employer plans are slightly different. After they vest, you're free to sell the stock or continue to hold or even transfer it out to a different account. It's your stock, you can do with it whatever you want. But unvested shares are not really owned by you. So typically you lose them when you leave employment. Now, so the big question is, when should I sell? Well, obviously you should sell when the stock is high, right? No, really, that is the best time to sell your stock. Unfortunately, we really don't know when that will be, right? So what do most people do? Here's what they do. They say, oh my gosh, my stock is going down. I can't sell now. I've got to wait until it gets back up to wherever, right? So I'm not going to sell, the stock's going down. Or if the stock's going up, I can't sell now because the stock's going up. You know, I'm making all this money, I can't sell. So how does that strategy end up? It ends up that you never sell. And that may be why you have a lot of stock today, or it may not be, but that is the way most people sort of think about not just RSUs and their own personal stock, but their personal investing. And it's a really terrible way to invest. So here's an approach that I would suggest for you to consider. So when should you sell? Well, the first question you should ask is, when are you going to actually use these funds? When are you going to spend the money? And if it's within the next 5 years, I would strongly consider going ahead and selling, because we don't want to have money invested in the markets. We don't want to have money at risk that we're going to spend in the next 5 years. You know, it's impossible to know what the markets are going to do tomorrow or the next day or the next week or the next year or the next 4 years. We can have a little bit more confidence over the next 5 years, the next 7 years, the next 10 years, and even more confidence over the next 20 years or 30 years. But it's those shorter periods we just don't know. And so we don't want to have money at risk like the college fund or things like that. Maybe money that we're saving to buy a house or buy a car. We don't want that money at risk. So if this is money you're going to use in the next 5 years, really strongly consider selling it. And then the next question is, okay, if it's money beyond 5 years, what does the rest of your investment portfolio look like, right? If your stock is more than 10% of your total portfolio, now this is a rule of thumb, and I don't like rules of thumb, but this is, I think, a pretty good one. If it's more than 10%, really consider selling. Now that doesn't apply to everybody, right? I have a client who has $10 million portfolio and he has $3 million in his company stock. And when we do his plan, he's not even going to spend any of that company stock money for the things that he wants to do. That's a great position to be in. So does it matter that he has 30% of his portfolio in his company stock? If it goes to zero, does it affect his lifestyle? Does it affect his plans? No. Okay, well, for that client, maybe we need to rethink, what's possible, right? But for that moment, probably doesn't matter. Most people aren't in that situation, of course. And then if neither of those are true, if it is money that's longer than 5 years, and if it is less than 10%, I still think you should consider diversifying, because remember, your income comes from your employer, and now you have stock tied to the employer as well. So you're definitely, taking some employer risk there, certainly. So what about taxes? Well, that's kind of what this is all about, right? Vesting RSUs. So we're going to talk about two different things. Vesting RSUs, in other words, RSUs that are vesting right now, and then vested RSUs, RSUs that vested some time ago. For RSUs that are vesting right now, you are taxed as if you got that money in a paycheck. So let me say that again. It's as if the company wrote you a check and you're taxed on that money, and you turn around and bought stock. So when a company gives you stock, when it vests, not when it's awarded, but when it vests, that's what the IRS says. The IRS says, aha, you got a paycheck for this dollar amount, we're going to tax you on it. Now, the question I would ask you is, if the company actually did write you a check, would you turn around and buy stock in the company? Have you ever done that? Has it ever crossed your mind with a paycheck? Aha, getting paid on Thursday, I need to hurry up and buy stock. I would guess probably not. So why are we holding on to that stock? Well, that's a good question. From a tax perspective, it makes no sense to hold on to it. So for vesting RSUs, as a general rule, I would say sell as you go. Now, for older RSUs, this is where it gets a little bit more complex, maybe a lot more complex, depending how much you want to get into it. But it really depends on what your situation is. So it depends on the things we've already talked about: your need for the cash, your concentration in stock, the diversification of your portfolio, your tax situation in each lot, but also your personal tax situation. If you expect to have high tax rates this year and low tax rates next year, do the math. Maybe it makes sense not to sell so much yet. Maybe it makes sense to wait. If you're retiring next year, that's a good example of when that might happen. Remember, you might lose the unvested shares, but the vested shares are still yours. So if we're looking at selling those older positions, and let's say we're looking at selling them over time, if we have a large amount of stock, we want to make sure that we're getting the most value out of the stock for the least tax cost. And this is where I'm going to dive into a spreadsheet. I love spreadsheets. I apologize about that, but this is a fairly complex spreadsheet, and so I'm just going to warn you up front. Happy to share it with you afterwards. In fact, I'll just send out a link to it whenever I send out the follow-up. And so I'm going to talk through this. I want to get through this in just a few minutes, because I want to stick to that 20-minute time limit and have time for questions and all afterwards. But let's just sort of get into it right here. So, okay, so. Oh, somebody just asked, is this being recorded? Yes, this is being recorded, absolutely. Okay, so here's the spreadsheet. So this is just the date, that we entered the data. Here's the stock ticker symbol is stock. That's a good generic stock ticker symbol. Stock is currently trading at 190 bucks. This particular person or family has a short-term tax rate of 50%, long-term tax rate of 25%. That's the marginal rate, meaning the rate that the next dollar is going to get taxed at. And then here's all the RSUs right here in this bucket. So they've got this family's got RSUs that were issued in 2016, 17, 18, 19. You can see the vested shares, 400, 300, 200, 100. Here's the cost basis. I'm going to talk more about that in a moment. Here's the current market value. And so we have some gains in these stocks, right? And now we've got the tax cost. Because we know the tax rate, we can figure out the tax cost. So overall, this family has $190,000 in stock, $20,000 in, well, I should say $56,000 in unrealized gain, $21,000 in tax costs. So the net proceeds, if they were to sell everything today, we would estimate that they get about $170,000 net. Now, you may look at that and say, great, I'll take it, right? I get to diversify out of this stock holding into my regular long-term portfolio, and I get to keep $169,000. But maybe the numbers could be a little different. Maybe the taxes are a little bit higher. Maybe they're just large numbers, or maybe these are large numbers for you. And you might say, you know what? I don't want to pay this $20,000 in tax all in one year. I want to spread it out. Well, here's how we would do that. Now, remember, these are each individual awards. This was the award for 2016, the award for 2017, and so on. So now this is where the spreadsheet gets a little complex. Now I'm going to scroll up. And now I'm taking this one line right here, the award for 2016, and I'm breaking it out into the lots. And what do I mean by lots? What I mean is when they got that award in 2016, they didn't get anything. They didn't own anything on that date. It took 1 year to 2017 for the first batch to vest, and then 2018 another batch, 2019 another batch. So we've got the vesting here, 2017, 18, 19. Luckily enough, it's just 100 shares per period. That makes the math pretty easy. Now here's the vest price. Now what the heck is the vest price? Well, that is the price of the stock on the day of vesting. So on March 15th, 2017, when this 100 shares vested, the stock price was at 80 bucks, and the IRS said, you just got a check for $8,000 in compensation, 80 times 100. I'm going to tax you on it. And so this family paid tax on that compensation at that time. And then a year later, they got another 100 shares, and stock was $120. So now they paid out a little bit more tax, right? And then $180 and so on. So continuing right across, we've still got 100 shares. We haven't sold any yet. Here's our cost basis. Now that's what I just figured out for you, right? This vested at $80, so the cost basis is $8,000. Remember, you've already paid tax on that. So that money is yours. On the day that it vests, it's yours. You've already been charged tax. The market value today, because now we're several years later, is $19,000. So we've got an unrealized gain of $11,000, which is 58% gain. That's great. It went up. Of course, you want it to go up, but taxman says, you know, I only tax you on 8,000 of that. I've got to tax you on the rest. The difference between 8 and 19, I got to tax you on 11. And luckily, we've owned it more than a year, so it's long-term tax. So how much tax are we going to pay? About $27.50. That's our tax. So why am I doing all of this math? All right, it's a lot of math, a lot of spreadsheet work. Here's why I'm doing it. If you look at right here, this is the tax cost divided by market value. If you think about that, this is the price we're going to pay, 14% of the value to get our shares. So we're going to lose 14% of the value. For the next lot, we're going to lose 9%. For the next lot, we're going to lose 1%. When I say lose, I mean we're paying it to the tax man. Now, if we're going to sell these shares over a number of years, if we're going to sell it all in 1 year, just sell it. Don't worry about it, right? We've already looked at that. But if we're going to sell it over a number of years, we want to sell the most market value for the least tax cost. And so that's what this ratio is telling us. So this 1% is a very low tax cost for the market value. So again, all of this is the 2016 award. Here's the 2017 award, the 2018 award, and the 2019 award. You know, we've only had one lot vest, but there it is, tax cost of 18% because the stock has gone up. It vested at 120. You know, in the March, markets were down, so we got some vesting at a low price. Taxman didn't get us for too much. He's going to come back for the rest. All right, so now we got this tax cost market value thing figured out, right? What does it cost us per dollar to sell? Well, what we need to do now is we need to sort all these lots by this tax cost so we can focus on the low tax cost. So what I did in the spreadsheet, and this is manual, it's not automatic, not that good at spreadsheets. So what I did was I took each one of these individual lines, right? And I just copied them right over here. And then I sorted them by tax cost. So now I know my lowest tax cost lot is the one that came out, was awarded in 2018, vested 2019, right? 1%. And then another one awarded in 2016, vested in 2019, and so on. Okay. We know our total tax cost is right here, $42,000. We want to realize it over 3 years, so we just divide it by 3, right? So we're gonna realize $14,000 in tax cost. I'm pausing because I don't think that's right. It's not. Aha. See, this is the problem with spreadsheets. Sometimes you got a problem. There we go. All right, that's what I thought. $21,000 in tax cost, 3 years, $7,000. Not sure why I did that. I'm going to get rid of this. Clear contents. Okay, there we go. $7,000 in tax cost per year for 3 years. What are we going to sell this year? Well, here's what we do. We've got this in order. We just scroll down here until we get to about $7,000. And I don't know if you know what I'm doing here, but I'm highlighting this. I'm looking down here where it gives me the sum. Very small number, but that says $7,000. What that means is we can sell all of these positions and realize just $7,000 in tax cost. Well, how much is that? Well, in market value, that's $114,000. We only have $190,000 in stock. But we're going to sell more than half of our stock in the first year and realize just a third of our tax cost. And why are we doing that? Because we want to reduce our exposure to our company stock as fast as we can, but we're reluctant to pay the total tax cost in 1 year. Now, if it were me, sometimes I think it's okay to just go ahead and blow it all out and pay the whole tax cost in 1 year. Sometimes you want to do it over 2 years, 3 years, 5 years. Depends on the situation. That's something that you got to kind of figure out for yourself. Somebody just asked a question, on the date of vesting, we pay income tax. Yes, that's exactly right. When you have an RSU, when it vests, the IRS says, you owe tax. You got to pay us. And so that's what they do. Now, it's different for options. Incentive stock options and non-qualified stock options, that's totally different thing. ESPP, totally different thing, right? We're only talking about RSUs here. So, so that's where we are. So that's the spreadsheet. That's how I think about it. Again, the spreadsheet's kind of like, level 401. You don't have to go that far up. You can, if you look at a high level, first off, if you're selling them as they vest, because you don't need to hold on to them. That's great. And then if you have a bunch, you can do this sort of light analysis, figure out what the tax cost is. If you're okay with the total tax cost, go ahead and take it. If not, then maybe think about doing it over a few years. So see, a few questions are coming through. I'm also do a podcast. It's called Deliberate Money Moves. It's available everywhere, iTunes, Spotify, everywhere. My blog is on my website, Best Fin Life, because the URL Best Financial Life costs too much and I didn't want to pay it. I'm cheap. But Best Fin Life is good. And then I'm doing weekly educational videos on my Facebook page. Facebook page, again, just search for Best Financial Life and it'll be there. Another thing I'm doing with this whole COVID-19 thing is I'm offering a free half-hour conversation on any financial topic you want to talk about. And when I say free, I mean there's no cost and there's no sales pitch, I promise you. I just want to help my friends and neighbors. So if you're interested in that, you can email me and I can set you up with that free conversation. So with that said, we're right at 20 minutes. I'm going to go to the question. Thank you so much for registering and attending, and look forward to connecting with you some other time. Take care.